There's a quiet earthquake happening on the other side of the world. It's not making the frantic 24/7 breaking news cycle, but its tremors are about to be felt in our careers, our wallets, and our investment accounts. Welcome back to Wealthwise, the podcast where clarity meets strategy. Today, we are pulling back the curtain on a topic that is profoundly misunderstood: the silent crisis in China's economy. And to guide us through this complex landscape, we have the perfect guest. Max Wise is a global macro analyst and investment strategist. He has a rare talent for connecting the dots between massive geopolitical shifts and the practical financial decisions we all have to make. Max, it's a genuine pleasure to have you here. By the end of this conversation, you will understand three critical things. One, why an economic slowdown halfway across the globe could rewrite your entire investment playbook. Two, the crucial warning signs that the mainstream headlines are missing. And three, most importantly, how to start seeing the hidden opportunities that always emerge from uncertainty. Max, welcome to the show. It's so good to have you. So let's dive right in. When most people hear phrases like China's GDP or producer price index, I think their eyes tend to glaze over. It feels distant, abstract, and almost irrelevant to their daily lives or their 401k. From your perspective, why is this topic so profoundly misunderstood?
Sarah, thanks so much for having me. And that's the perfect question to start with, because the core misunderstanding comes down to a single, dangerous illusion: the illusion of separation. We think that's their problem, over there. But in today's world, there is no over there. Think of the global economy not as a collection of separate countries, but as a single, finely tuned engine. For the last 30 years, China has been one of its most critical components. It's not just the world's factory anymore. It's also the world's biggest customer for everything from oil and metals to luxury goods and technology. When a component that significant starts to sputter, the entire engine vibrates. You can't just ignore it.
That's a powerful analogy. The whole engine vibrates. So what's the other big misconception you see?
It's a subtle but far more dangerous one. It's the public's reaction to the word deflation. We've spent the last few years fighting inflation, so when people hear that prices in China are falling, their first thought is, great, cheaper stuff. It sounds like good news. But from an economic perspective, it's a massive red flag. It's a symptom of a deep-seated sickness in the economy. Falling prices don't happen because companies are feeling generous. They happen because people are too scared to spend money. Businesses get desperate. They have to slash prices just to get products off the shelves. This creates a psychological paralysis. If you know that car or that new phone will be cheaper next month, why would you buy it today? You wait. Everyone waits. And when everyone waits, the economy grinds to a halt. It's a downward spiral of falling demand, falling profits, and ultimately, rising unemployment.
So it's not just an economic indicator, it's a measure of public fear.
Exactly. It's a vote of no confidence from the average person. And we've already seen how directly their internal policies can impact us. Let me give you a concrete example. Remember in 2022, when you couldn't get a new sofa or a PlayStation for months, when shipping costs went through the roof? That was a supply shock caused by China's zero-COVID policy shutting down ports and factories. It was a direct consequence of their internal decisions hitting our shores. Now the problem has flipped on its head. It's not a supply shock. It's a demand shock. Their own people aren't buying. And that slowdown, that fear, is the real story here. It's what's causing the cracks to appear in their economic foundation, from a collapsing real estate market to historic levels of youth unemployment. And that, Sarah, is where we need to start our deep dive, into the actual cracks in that foundation.
Max, you left us with a powerful image: cracks forming in the foundation of China's economy. So let's get into the specifics. What is the single biggest crack in that foundation right now?
Without a doubt, Sarah, it's real estate.
For the better part of 3 decades, China's economic growth wasn't just supported by real estate. In many ways, it was real estate. We're talking about an industry that, directly and indirectly, accounted for up to 30% of their entire GDP. That's a staggering figure, far larger than it was in the US before our own housing crisis in 2008.
30%. That's almost a third of their entire economy resting on one pillar.
Exactly. And that pillar is now crumbling. The headlines you might have seen about giant developers like Evergrande or Country Garden defaulting on tens or even hundreds of billions of dollars in debt are just the tip of the iceberg. Those are the dramatic, visible symptoms of a much deeper disease. The core of the problem is a business model that was built on a promise of endless growth. Developers would borrow massive sums of money, buy land from local governments, who, by the way, depended on these sales for their own revenue, and then they would pre-sell apartments to everyday citizens before a single brick was laid. People poured their life savings and the savings of their parents and grandparents into these unfinished apartments, believing that property values could only go up. It was seen as the safest investment you could make.
It sounds like a house of cards built on unstoppable optimism.
It was. And the wind has changed. The government, realizing this was an unsustainable bubble, started cracking down on how much developers could borrow. That move, intended to prevent a crisis, actually triggered it. The cheap money dried up. Construction on millions of pre-sold homes stalled. So now you have a tragic situation. You have millions of middle-class families who have paid for a home that doesn't exist and may never be finished. You have giant developers who are effectively bankrupt. You have banks holding mountains of loans that will never be paid back. And you have local governments that have lost their primary source of income. It's not just a financial crisis, it's a social crisis. It's a profound breach of trust between the state and its citizens.
So this isn't just about stock prices for developers on a screen. This is about the tangible life savings of millions of people vanishing.
That's the heart of it. We're talking about a slow-motion version of the 2008 crisis, but in a system with far less transparency and a much weaker social safety net. When people see the primary vehicle for their family's wealth evaporate, it doesn't just hurt their finances, it shatters their confidence in the entire system. And that loss of confidence is contagious. For decades, China's economic miracle, it was built on the foundation of real estate. That foundation isn't just cracking, it's crumbling.
That's a terrifying picture, Max. So when a family's largest asset, their home, is either unbuilt or plummeting in value, how does that impact the psychology of the average person? How does that change their behavior?
It changes everything. It flips the primary emotional driver from ambition to fear. And when fear takes over, people do one thing. They stop spending and start hoarding cash. We're seeing this in the data right now. China's household savings have hit all-time record highs. Now, this creates a fascinating paradox. For an individual, saving money when you're scared about the future is the most logical, rational decision in the world. But when 1.4 billion people do it at the same time, it's catastrophic for an economy that is built on consumption. If no one is buying, businesses don't make money. If businesses don't make money, they stop hiring and start firing. This is the spiral we talked about earlier.
And this is happening at a time when they're also facing a huge youth unemployment problem, right?
A massive one. The official figures put youth unemployment, that's ages 16 to 24, at around 15%. And many analysts believe the real number is significantly higher if you include those who have simply given up looking for work. Think about that for a second. You have a generation of the most highly educated young people in China's history, many of them with college degrees, graduating into an economy with no jobs for them. Their parents' wealth is tied up in a falling real estate market, and their own futures look incredibly uncertain. What do you do in that situation? You don't take risks. You don't start a business. You don't buy a new car or a new apartment. You save every penny you can because you have no faith that things will be better tomorrow.
So you have a short-term crisis of confidence layered on top of a long-term, almost irreversible demographic problem. It sounds like a perfect storm.
You've hit on the other critical piece of the puzzle, Sarah, the demographic time bomb. For decades, China benefited from a demographic dividend, a huge young workforce powering its factories. But the legacy of their one-child policy means that dividend has expired. The population is now aging faster than almost any other country in history. This means you have a shrinking workforce trying to support a ballooning population of retirees. It puts immense pressure on their social security and healthcare systems, and it acts as a permanent drag on long-term economic growth. They're essentially trying to get rich before they get old, and it looks like they might be running out of time. When fear becomes more powerful of a motivator than ambition, money stops moving. And right now in China, fear is in the driver's seat.
Okay, so this feels like a massive internal problem for them to solve. It's complex, it's multi-layered, but let's bring it home. Why should a young investor in, say, Ohio, or an entrepreneur in London really lose sleep over this?
Because, as we said at the start, there is no over there anymore. The ripples from this crisis are already hitting our shores in ways people might not even realize. Let's break it down into two channels, the corporate channel and the market channel. First, the corporate channel. Dozens of the biggest companies in the S&P 500, companies that are probably in your 401k or index funds right now, rely on China for a huge chunk of their revenue. Think about Apple. China is not only where they assemble most of their iPhones, it's also one of their biggest consumer markets. When Chinese consumers stop buying new iPhones because they're scared, that directly hits Apple's bottom line. Think about Tesla with its massive gigafactory in Shanghai. Think about Nike, Starbucks, or luxury brands like LVMH. Their growth stories for the last decade were heavily dependent on a rising Chinese middle class. That story is now in serious doubt.
So the risk is that the China growth story that so many global companies were banking on is now over.
It's at the very least on an extended pause. And it's not just about them buying our stuff, it's also about them making our stuff. If their factories slow down due to a lack of global demand or internal problems, it can still create supply chain snags. And for other countries, a weaker China means they buy less oil from the Middle East, less iron ore from Australia, less technology from Germany. The ripple effect is global.
Okay, that's the risk. It sounds pretty grim, but this is wealth-wise, so we have to ask, where is the opportunity in all of this?
This is the most important question for an investor, and the opportunity lies in the market channel. Crises create repricing events. Fear causes people to sell assets indiscriminately, often pushing prices far below their long-term value. For the savvy, patient investor, this can create a potential once-in-a-decade buying opportunity. Now, let me be crystal clear. This is not a recommendation to go out and blindly buy Chinese stocks. The risks are enormous. Political risks, transparency risks, regulatory risks. However, you can start to see opportunities. For example, you can look at ETFs that track the Chinese market, like MCHI, or the internet-focused KWEB. They've been beaten down severely. For someone with a high risk tolerance and a 10-year time horizon, they might see this as a moment of maximum pessimism and a chance to buy at a deep discount.
So the takeaway isn't panic and sell everything. It's pay attention and understand where the risks and therefore the potential opportunities are shifting.
Precisely. The other, perhaps safer, opportunity is to look at the beneficiaries of this shift. If global companies are de-risking their supply chains away from China, a trend called friend-shoring, where is that investment going? It's going to places like Mexico, Vietnam, and India. Understanding this global capital flow is how you position yourself for the next decade, not the last one.
Being aware of China's problems doesn't just mean you're avoiding risk. It means you're actively searching for where the next growth story will come from. The global economy isn't a series of separate houses. It's one interconnected building. A fire in the basement in China will eventually send smoke up to the penthouse in New York.
Max, your analysis of these global ripples is incredibly clear. It highlights how easy it is to be blindsided if you're only looking at your own backyard. It makes me wonder, in your own career, was there ever a turning point, a moment where you underestimated a global event and it taught you a lesson you've never forgotten?
Absolutely. And it's a lesson that is painfully relevant to what we're discussing today. For me, it was the European sovereign debt crisis back in the early 2010s. I was younger then, working as an analyst, and frankly, I was full of that classic Wall Street confidence. My focus was almost entirely on the US market. I was deep in the data on American companies, American consumers, and the Fed's policies. Then this noise started coming out of Europe. News about Greece's budget deficit, about bond yields in Portugal and Spain. And my initial reaction, and the reaction of many of my peers, was a kind of intellectual arrogance. We thought, what does Greece have to do with us? Their entire economy is the size of a single U.S. state. It's a rounding error, a local problem for the Europeans to sort out.
The illusion of separation you mentioned earlier.
The perfect example of it. I fundamentally failed to appreciate the interconnectedness of the global financial system. I saw countries, not a network. I thought our markets were insulated. But then the contagion started. The fear didn't stay in Athens. It jumped to Lisbon, then Madrid, then Rome. Suddenly, it wasn't about Greece's debt anymore. It was about the stability of the euro. It was about the health of major German and French banks that held that debt, banks that were deeply intertwined with our own financial institutions in the U.S.
And you started to see that ripple effect in your own work.
I started to feel it. I remember watching my screen one afternoon as the U.S. markets, which had been perfectly stable, suddenly took a nosedive. There was no bad news in America that day. The trigger was a rumor about a potential default from a European bank. And I had this sinking feeling in the pit of my stomach. It was the feeling of being completely, fundamentally wrong. My portfolio, which was built on the strong U.S. thesis, got hit hard. Not because my analysis of American companies was wrong, but because my worldview was too small. The market taught me a brutal lesson that week. Capital doesn't carry a passport. Fear doesn't respect borders. In a globally connected system, a tremor in a place you considered irrelevant can cause a tsunami in your own portfolio.
What was the biggest change you made to your own strategy after that experience?
It forced me to develop what I call macro empathy. It's the ability to truly understand that a problem in one part of the world creates real fear, real behavioral change, and real financial consequences everywhere else. It's why I follow what's happening in Chinese real estate as closely as I followed the U.S. jobs report. That experience cost me money, but the lesson it bought was priceless. It taught me that there are no financial islands anymore. We're all on one massive, interconnected continent.
That lesson on interconnectedness feels more urgent now than ever. It's the perfect setup for my next question. As you look at this new, fractured global landscape, if you had to bet on one major shift that will define financial success for investors and businesses over the next 3 to 5 years, what would it be?
I would bet on a single powerful idea. Resilience is the new efficiency. For the last 30 years, the entire global economy has been optimized for one thing: maximum efficiency. That meant finding the cheapest place to manufacture something, no matter where it was, and relying on just-in-time supply chains that were incredibly lean, but also incredibly fragile. China was the undisputed champion of that model. The pandemic was the first major crack in that philosophy. The current situation in China is the second. Businesses and governments are now realizing that fragility carries a massive hidden cost. A supply chain that saves you 10% but breaks every 2 years isn't efficient at all. It's a liability.
So, what does a resilient world look like?
It looks like diversification. It looks like companies actively pursuing what's being called a China plus one strategy. They're not necessarily leaving China entirely, but they are aggressively building out alternative supply chains in other countries. This is the trend of friendshoring or nearshoring. Instead of just asking, where is it cheapest, CEOs are now asking, where is it safest? Where is it most predictable? The capital flows are reflecting this. We're seeing massive new investments pour into manufacturing in Mexico, which benefits from its proximity to the U.S. market. We're seeing a surge of interest in Vietnam as a hub for electronics and apparel. And we're seeing India rise as a powerhouse not just in services, but increasingly in manufacturing as well. For an investor, the mindset shift is crucial. The winning companies of the next decade won't be the ones that are the leanest, they'll be the ones that are the most robust. The opportunity isn't just in betting on these emerging economies, but in investing in the enablers of this trend. Logistics companies, industrial real estate, automation and robotics firms that help make these new supply chains work.
So the smart money is following the shift from a hyper-efficient, fragile model to a multipolar, resilient one.
Exactly. The world is getting messier, but it's also creating a whole new set of winners and losers. The key is to see the map as it is today, not as it was 5 years ago.
From shattered confidence in real estate to the psychology of fear to the future of a resilient global economy, Max, this has been an absolute masterclass in connecting the dots. Thank you so much for your time and your incredible insights today.
The pleasure was all mine, Sarah. Thanks for having me.
For everyone listening, I hope today's conversation helped you see that understanding the global economy isn't some academic exercise. It's a fundamental tool for protecting your assets and identifying new opportunities in a rapidly changing world. We've moved from the illusion of separation to the reality of interconnection. If you found value in today's episode, here are 3 simple things you can do to support the show. First, share this episode with one friend or colleague who you know is serious about building their financial future. Second, if you haven't already, please hit that subscribe or follow button on whatever platform you're using. It's the best way to make sure you never miss our weekly breakthroughs. And finally, leave us a comment. We'd love to know, what was the single biggest takeaway for you from this conversation? We read every single one. Thank you for investing your time with us today. Always remember, financial freedom isn't a dream you hope for. It's a strategy you execute.